My question is about when a reasonable time is to consider adding private real estate investments to your portfolio. My spouse and I are new attendings in our first few years of practice. As you have mentioned before, we have plenty of good uses right now for our new incomes, including student loans, maxing out our retirement accounts, saving a down payment for a house, and starting 529s for our kids. Right now, we are aggressively investing into our 401ks, backdoor Roths, HSA, and a small taxable account with an asset allocation that is mostly equity, some bonds, and a small amount of the Vanguard REIT index fund. Eventually, I think we would be interested in adding private real estate into our portfolio for additional diversification, likely in the form of a fund such as the ones you advertise on your site. The cost of entry to many of these funds is relatively high, and right now does not seem like the time to do this since it would take us longer to save that amount of money instead of making our monthly investments into the other accounts I mentioned. So my question is, at what point in a high-income professional's financial life does it make sense to start adding in these types of investments? Is it at a certain level of net worth or portfolio size? Or how should I think about planning for this for the future? Thanks so much for any insight you have.
Okay, that's a great question. Well, let's start at the very beginning here. Real estate is not mandatory. Yep, I said it. You don't have to invest in real estate in order to reach all of your financial goals. You certainly don't have to invest in private real estate to reach all of your financial goals, and you certainly don't have to be a direct real estate investor. Landlording is not mandatory for financial success, for becoming a millionaire, for being financially independent, for retiring successfully. It is not required. I had zero private real estate investments when I became a millionaire. I guess we had still our, accidental landlording property out in Virginia that we couldn't sell in 2010. I guess we owned that, but it certainly wasn't making much money and really didn't contribute to that first $1 million we had. So this is all optional. Let's keep that in mind. So there should be no rush to add something that's optional in the first place. Okay. You want to invest from a position of strength. And for most high income professionals, most doctors, you have more and more financial strength each year of your career. You come out of residency, you got a negative net worth, you owe $200,000 or $300,000 or $400,000 in student loans, you hardly have anything to your name. You're not in a particularly strong position. But if you're doing things right, a month later, you're in a slightly better position. And the month after that, a little better, a little better, a little better. And that is the way the last 20 years of my career have been since I came out of medical school in 2003. Every month, I have been wealthier than I was the month before. Now, maybe that's not entirely true. And there's a big, nasty downturn and I lose a bunch of money in stocks or something, my net worth actually goes down. Or maybe, when you put down a big down payment on a house or you buy a new truck or a boat or something, your net worth actually goes down that month. But as a general rule, year after year after year, you become wealthier and wealthier and wealthier and wealthier if you're doing this right. And your money starts to do more and more and more of the heavy lifting as you go along until eventually at some point, the money being generated by your money dwarfs the amount of money that you can make by going to work and earning. And so that's just, the general backdrop of a physician's financial life. Okay, so now if we talk about real estate, the easiest way to add real estate to your portfolio, assuming you want more than what's in just the basic total stock market index fund, is to tilt your portfolio toward real estate, publicly traded REITs, which are real estate investment trusts, by using something like, my favorite ETF in this space, the Vanguard REIT Index Fund. Okay, ticker symbol VNQ. I can't remember right now what the fund version ticker is, but I use that. Okay, I've been using it for a long time. I first added it to my portfolio in 2007. That was a mistake, by the way. Lost 78% of what I put in there in 2007 in the subsequent bear market in 2008. But such is life. It wasn't that much money, and we continued to add to it over the years. We'd have a very good return over the years from that fund, even though it started out with a pretty nasty return that first year. That's the way investing goes when you're investing for the long run. Okay, so it sounds like you, meaning the person asking this question, wants to do more than that, and that's fine. right? I have a portion of my portfolio that's dedicated to private real estate. I've invested in some syndications in the past, but primarily my investments now are private real estate funds. I think the solid returns there, as well as the lower correlation with the overall market, is worth the hassle and expenses of dealing with that asset class. And so our portfolio is 60% stocks, 20% bonds, and 20% real estate. Of that 20%, 5% is still in B&Q, which is publicly traded REITs. 10% is in equity real estate, almost all in funds. Just a little bit of syndication still there. And 5% is in debt real estate, all in funds. And that's money that's loaned out to developers who are essentially developing and flipping properties. And so that's what we invest in. Now, these investments, as you've noticed, if you're subscribed to our real estate investing opportunities list, which is free, by the way, you can just go to whitecoatinvestor.com/newsletter and sign up for that. You can unsign up for it if you feel like you're getting too many emails from us. No problem. We won't be offended. Don't nuclear unsubscribe from everything or you won't get the blog posts or our monthly newsletter. But you can unsubscribe anytime you want from that real estate opportunities list. But as you've noticed, they have fairly high minimums. And that's not an all bad thing. Okay? High minimums mean that they're managing fewer investors. And so that cost savings in some ways can be passed along to you. If they're trying to manage a whole bunch of investors with $80 in the investment, that's very expensive and lots of hassle and very time consuming. And some of the regulations actually make it difficult to have small investors in those investments. And so the investments tend to be high. You can find some that are 15 and 20 and 25,000, but most of them honestly are 50, 100. I think the highest one I've invested in had a $250,000 minimum. And so that just doesn't work at the beginning of your career, right? If you're making $150,000 a year and you're saving 20% of a year, that's $30,000, right? If you're trying to hit a $100,000 minimum investment, that's over 3 years worth of investment savings just to do that. That's not going to work for you. Now, you've got to have a higher income than that if you want to play in this space and actually have a diversified portfolio. Or you have to have a bigger portfolio, which after many years you can. These investments all require you to be an accredited investor. And what the federal requirement for that is you have to have had an income of at least $200,000 a year for each of the last 2 years, $300,000 together with your spouse, or you have to have investable assets of at least $1 million. That's their minimum requirement. That's what they call an accredited investor. Now, if you're a trust or whatever, there's some other definitions of that, but that's what it is for most individuals. And that hasn't changed in many years, to be honest with you. And minimum investments have gone up over those years. So that tells you a few things. One, it's kind of an outdated definition. And two, it was never a good definition to start with. What is an accredited investor? An accredited investor, in my mind, is two things. One, you can afford to lose the entire investment without it affecting your financial life. And if that's true, that means you've got a fair amount of money and a fair amount of income if you're losing a $50,000 or $100,000 investment without it really affecting your financial life. So you got to be wealthy, at least high income, better yet, wealthy. Okay. And two, to be an accredited investor, I think you need to be able to evaluate the merits of the investment yourself without the assistance of anybody else, meaning attorneys, financial advisors, accountants, etc. If you need a whole team to evaluate this investment, that's probably going to decrease the returns on the investment enough that it's not worth it for you. I think you also ought to take those, government mandated numbers and double them. Not only double them, but instead of having them be either or, have them be and. Meaning you're making at least $400,000 a year in your household, and you've got at least $2 million in investable net worth, investable assets. And I think that's about the mark where this stuff can start making sense to add to your portfolio because the minimums are so high and you still need to be diversified, right? You are outside of the public markets here. This is a place where scammers abound, where incompetence can abound among operators. It's not that hard to start up a syndication, it turns out. And so you need to be, kind of heads up when you're investing in this space. And it helps if you are, already wealthy. So that's kind of my take on it. Do you have to wait that long? No. If you meet the requirements of an accredited investor, you can invest. If you're okay not being diversified and adding one of these at a time over several years, you can invest. That's your call if you want to do that. But my recommendation is be able to have a diversified portfolio from the beginning. And maybe that means you got to lean toward the ones that have lower minimum investments, 10,000, 15,000, 20,000. We've got a number of sponsors, that are kind of crowdfunding platforms, for lack of a better word, that can get you into investments with those lower minimums. And that's absolutely where I started with them. The nice thing about those lower amounts is you get to kind of dip your toe in the water and try them out a little bit and still be somewhat diversified. The downside is you get the same exact number of K1s, whether you have $10,000 in there or $1 million in there. And you have the same cost and hassle of dealing with filing that K1, which may include filing multiple state tax returns, which is an expense and hassle. If you're filing them yourself, it's a hassle. If you're not filing them yourself, it's an expense. But same thing, really. So keep that in mind. That's when I think it's appropriate to be looking at these things. If you are a gynecologist making $350,000 yourself, you're married to a neurologist who's making another $325,000 yourself, you're 8 years out of residency, you've paid off your student loans, you got a 7-figure portfolio. Yeah, this stuff's worth taking a look at and seeing if you want to, include that as part of your portfolio. If you came out of residency last year, you are a PM&R doc making $210,000, you owe $350,000 still in student loans, you got a 5-figure portfolio, this is not for you yet. All right. And, it doesn't ever have to be for you. That's okay. You don't have to invest in this stuff. Don't forget, right? White Coat Investor is multiple things. Okay? White Coat Investor is an educational platform. We want to teach you about money. We want to help docs stop doing dumb things with their money. We want to help you get a fair shake on Wall Street. White Coat Investor is also a business. 15 people work here. Okay? They all like paychecks, I assure you. They're all still cashing them. All right. And they want their health insurance, right? So this thing has to make money. And so we have to have profit. And so we have advertisers, just like we had an advertiser at the beginning of this podcast, Laurel Road. We have advertisers in real estate. Okay? And you're going to hear about this stuff, in the form of ads on the podcast, and you see them on the blog and that sort of stuff. But keep in mind that there is content and there is ads. And if you're having trouble telling them apart, let me know and I'll make it real clear for you. Okay? Because it's very clear in my mind what is content and what is ads. And if that's not clear for you, we probably need to make some changes to make sure it's clear for everybody.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.